Hello and welcome. I'm Rich Harvey, CEO of Property Buyer, and welcome to our webinar tonight, The Psychology of Property Investing and Finance. And I'd like to give a very special welcome to Terry Ryder, Managing Director of Hotspotting. Welcome, Terry.
Hello, Rich. How are you doing?
Very well, thanks. Great to be with you again on this webinar this evening. Now, we've got a really interesting topic tonight, Terry. This is one I've been wanting to do for quite some time, to really unpack the psychology behind decision making for both property investors and home buyers out there. Because I see a lot of people making decisions on a whim or making decisions on one piece of hot data or one article, but without really getting behind what it is that they should be doing. So today I really want to look at and address a lot of investors' strategies and really delve into the detail, Terry. So I hope you're ready for a good topic tonight.
Yeah, I think you could argue that this is probably the most important topic that we could possibly discuss for property investors. There's far too many. I'd say the vast majority of people decide they're going to get into property investment and they just dive straight into looking for things to buy online without putting any time or effort or money into thinking about what they're trying to achieve, making a plan, developing a strategy, and taking on board some expert assistance and advice to make sure they do it well. So I think it's, number one topic that should be out there for property investors.
And I think, Terry, a lot of people don't really think about the way in which they make decisions, or they might hear of a strategy and then start that strategy and hear of a better strategy and jump and chop and change. And they end up, not knowing which strategy is actually going to deliver the best result from them. So I think it's really important that investors get a thorough understanding of the strategies that they're going to follow. And just think about how they make decisions. So to that end, Terry, look, tonight we're going to do a couple of things, and I'll just share a bit of a quick overview with everyone on the screen as to how that's going to work. So I'll just bring up the slides, and look, we'll flip between the slides as well and our faces, so everyone's engaged. So that's our topic, the psychology of property investing and finance. We're going to be looking at the cycle of property emotions tonight. We're going to be looking at good data versus bad data. What do you determine is good versus bad out there in the data world? How to set strategies and how to set some goals, how to get motivated to take action. And then we're going to do a brief market update as well, Terry, and have a look at how things are progressing out there. Now the market's certainly in recovery in a lot of the markets around Australia. But Terry, let's look at this and spend a bit of time on this. I've created a slide here called the cycle of property emotions. Very similar to the sort of cycle of emotions people go through in investing in the share market. So the theme of this slide is that we all start off, with optimism or confidence, if you like, when we're thinking about investing into property. And that gives way to enthusiasm. We get really excited. We get out there, we're looking online at certain things. And then there's a sense of exhilaration or even jubilation when we find a property. And then there might be a next stage of the cycle where someone's bought a property, perhaps not bought a property, or they might get buyer's remorse and they get worried, nervous, alarmed, and then end up in depression, right, at the bottom of the cycle. And then they need to come out of that cycle of depression with reassurance, relief, and then back up to confidence. So, Terry, have you seen that sort of cycle of emotions with some of the investors that you've been talking to over the years?
Oh, absolutely. But I think in particular, we've seen that cycle play out across the nation since the start of this year. We've seen every stage play out. The first part of the year, there was a perfect storm of negative things impacting on real estate markets generally across Australia, particularly the impending federal election. Whenever there's a federal election, people just stop making decisions. But this one in particular caused a lot of concern and uncertainty because it appeared that Labor was going to win and implement some policies that were going to be very unhelpful to property investment. It was also in a climate where it was very hard to get finance, or much harder than before. So we had what I call a perfect storm of negative events. So we went through all of those negative emotions. People were nervous, there was alarm, to the point where markets were somewhat depressed, particularly in the major cities. And then since the middle of May, the election's out of the way, the unexpected win by the Liberals, and then a series of fortunate events that have followed, making it easier and cheaper to get finance, turnaround in sentiment. So we've seen the upswing from depression through reassurance. We're now seeing a lot of people feeling a little bit more relieved, and confidence has definitely returned. So this year has been a perfect illustration of all those points along the cycle of property emotions.
Mm. And why do you think that people have such wildly fluctuating emotions? Why do people go from having such great confidence in their ability to invest in property through to a situation where they're completely depressed? Why do you think that is?
I think it's because essentially we're herd animals. People like to follow the pack. They get swept along by the overriding sentiment that's out there, a lot of which is portrayed accurately or otherwise in mainstream media. And it's very difficult for individuals not to be swept up by all that. So in the first half of this year, mainstream media, our major newspapers, ABC, television and radio, was overwhelmingly negative about real estate. And that was exacerbated by the lead up to the federal election. And people just got caught up in that.
That's right.
I sometimes think that Australians are all connected to a single brain, and it's not necessarily a terribly bright one. And so it's just extraordinary the degree to which everybody just acts in unison. There's a federal election coming, so everyone just stops. No one will make a decision. No one will take action. Certainly not big spending decisions. And so things just come to a halt. And I know you must have felt that in your business. I know real estate professionals around Australia felt that as well.
Yeah, well, I think just on that, Terry, I think we've definitely noticed in our business the level of inquiry very much follows the herd. For us as buyers agents, we're getting a lot more inquiry now from people that are incredibly frustrated because the market's rebounded so strongly they just can't find what they're looking for. But we are, as you say, very much herd animals, and it's kind of hard to go against the herd and to be counter-cyclical. And I think that's one of the points you can take away from this webinar for our viewers tonight, is that you do need to be thinking about being counter-cyclical at some points in the cycle, but also have the nerve and have the confidence to jump into a market, even if it is rising, to know that it's the right kind of market that's going to perform long-term as well. So Terry, let's maybe just talk about how these emotions impact on the way in which we make decisions. So, for example, if we're confident or enthusiastic, obviously we're going to jump in on all fours and get right into an investment. But if we're always seeing the negative in things, then we're going to shy right away. So how can we avoid making emotional decisions? What's some of the tactics perhaps that our viewers could use to avoid falling into the trap of just leading with the heart instead of leading with the head?
Yeah, no, I think the point you just made is very, very valid, that people need to have the nerve to detach from the herd. I don't think anyone's ever become wealthy, and let's face it, what people are seeking to achieve with property investments is to grow their wealth. But I don't think anyone's ever achieved that goal by just following the herd. The people I know that have been the most successful property investment are the people who detach from the herd and head in the opposite direction. And I think it's true of all kinds of investments. People have been spectacularly successful and become truly wealthy are those who are really doing the opposite to what the pack are doing. Buying when others are selling, selling when others are buying. And it's a very simple philosophy, but it's one that has served really people really well. Because when people are following the herd, they're simply reacting to perhaps media sentiment, and it means quite often buying at the very wrong times. You want to be buying at the bottom of the cycle. A lot of people are buying at the top of it or after the top of it because they're following what the herd is doing and they're reacting to media.
I think, Terry, just on point on following the herd, I think we're not talking about going and being stupid about going completely the wrong direction. It's about having the confidence to jump into a market when people perhaps are a little bit scared to jump in the market. So we're not talking about buying 15 properties in Mount Isa or Moranbah again, just because you're chasing yield. We're not talking about pouring all your money into one very high capital growth market that doesn't have any proper yield. So I think there can be extremes where people might interpret this as we're recommending going to an extreme. We're not recommending that. We're just saying be aware of the emotions that you have and look at the data.
I think what we're recommending, Rich, is quite exactly the opposite of going to extremes. The people who bought in those kinds of boom-bust locations, the single industry towns, those dependent on the resources sector, are people who got swept up in overriding sentiment and followed the herd into those places. People dived into Gladstone because it became a media darling. Everyone was writing about it and reading about it. People just dived in without giving it a lot of thought, without considering the nature of the market they were getting into, and without doing any research about what was actually happening on the ground in locations like that. So I think what we're suggesting is quite the opposite. It's actually a very, very sensible strategy, rock solid in common sense and calm, sensible investing.
So then, just on that, Terry, how should we interpret the news around the property market? Because if a lot of us are media driven and we're making a lot of our decisions based on the 6 o'clock news or some series of reports on the property market, how should we interpret the news about the market? Should we sort of close our ears and not listen to it? You know, what should
absolutely.
we do?
We're seeking today to give people sensible strategies to avoid getting swept up in those that cycle of property emotions and get better outcomes as a result of it. And I think the first step is to just tune out from mainstream media. I mean, I've been, by career, I'm a newspaper journalist. That's how I started out. So I've been working in and around media my whole career. And I just think that right now there are no property experts writing for our major newspapers about residential real estate. They're just recycling press releases, and press releases by their nature are propaganda in which the provider of the press release has a vested interest. So I think that all people are going to gain from tuning into mainstream media is a lot of negativity and misinformation. And I often say to people, just stop reading newspapers, tune out. You've got to be informed in better ways. You're not going to be a well-informed investor, providing a basis of knowledge to make good decisions if you're using mainstream media or major newspapers as your main source of information. That's the worst possible strategy. So the first thing people should take away today is the importance of tuning out from all that static, that background clutter in mainstream media, which is sensationalist by nature, often very negative, even in positive times, and start finding better ways to be informed.
You know what, Terry, probably people remember too, watching this webinar tonight, that 60 Minutes did a story. I can't remember when it was, beginning of the year or whenever it was, but they asked me to be interviewed and a number of others. And they did interview quite a few people, but they tended to get people that were very negative on the property market. So, or very, one-eyed on the property market. And even the bears that they did interview, they didn't qualify their statements as well. So it was unfortunately created, that's a real sort of mark in the sand of a very sort of poor journalism from mainstream media, which created an enormous amount of fear amongst people right before, an election. 2 elections were happening in 2019. But the reality is, we look at the market now, and we'll talk about the market update later. The market is recovering quite rapidly and in certain pockets. And it's very important to have your ear to the ground to what's actually happening. So I think one of the messages particularly from this slide I'd like to get across is that we all go through these kinds of emotions. We all feel a sense of excitement and jubilation when it comes to buying a property, and that's great, but we've got to keep that in check. It's a bit like buying at auction. You can have a limit there, but if your emotions take over, you will exceed that limit and overpay for a property. So it's very important to keep your emotions in check, not just at auction, but all the stages of the cycle, so that you have a really level head and you're making a firm decision. But also, Terry, I'll sort of give an anecdote here. My first investment property, I was extremely nervous about buying my first investment property. And I was an economist by training, so I analysed things to 3 decimal points. And I was worried about going into more debt. And it took me a long time, several weeks, even a month or so, to actually get to a point where I was comfortable signing a contract for sale and also going into more debt. But I'm very pleased I took that first step to buy that first property, because that's led me onto my journey to buy multiple properties where I am today. And I think we do have to overcome a sense of fear, a sense of worry or potential doom and gloom in the economy to be able to move forward with confidence into to make good property decisions. So I think it's important to get others around you that provide independent advice and the right data, and don't try and do it alone. A lot of people go on their property investment journey and just try to do it on their own, but be very aware of your decision-making process that you go through.
Yeah. Look, I think that's absolutely right. All the people I know, Rich, who have been truly successful property investment. I'm talking about people who have substantial portfolios, 10, 20. There's one guy, Sydney-based, I know, who has around 40 properties now. The characteristic they all have in common is that they treat property investment as a business, and they understand that, like any business, you've got to spend money to make money. And so they gather around themselves a team of experts in a variety of fields, and experts in finance, an accountant that understands real estate, good research advisors, good buyers agents to help them find the right properties. And they're willing to pay for that advice and that input from, but they create a team, a really good team of trusted advisors in specialist areas, and they're willing to spend money on that. And that I think distinguishes the successful investors from the vast majority of people who get perhaps ordinary results or poor results because they're not willing to do that, not willing to put in time, and they're not willing to spend money.
So let's move on, Terry, to next theme is good data versus bad data. And let's have a chat about what sort of data should people be looking at to make good decisions. I think we see a lot of reports in the media, particularly around where house prices are going and where they've been, and the market in this suburb has dived 25%, but it might be coming off the basis of 4 sales. So what do you see is bad data versus good data, and what mistakes are people leaning on and making mistakes in?
Well, I think media tends to focus almost exclusively on median price movements as a barometer of markets. There's also quite a lot of attention given to auction clearance rates. Both those things can be quite misleading. There are many other important data points that I think are perhaps more helpful to people. They're not necessarily going to get them from mainstream media because of this obsession with what's happening with median price. Median prices, it can be very dodgy data, very rubbery figures, particularly if the sales sample is small. It's very common to see newspapers publishing lists of the top 10 places for price growth in the last 12 months. These are the places you should be investing in. And quite often, very often the worst places, one-horse mining towns perhaps recovering from the pits of 6 or 7 years of decline, starting to climb up from very, very low base. And so a high percentage growth in the last 12 months, very misleading because it suggests that these are good places to buy for growth, where in actual fact they're extremely dangerous places. I think other data points can give you very good clues to the places you should be focusing on. For example, rental movements are very often a precursor to what's happening with prices. I think we saw that in Sydney around 2011, 12 and 2013, before the big price boom started in Sydney. What we saw was 2 or 3 years of significant growth in rentals, but not in prices. And very often that's a precursor to a market moving into a boom phase in terms of price growth. So vacancies come down, rents start to rise. That's a market to look for.
Okay. I think auction clearance rates has always been touted as one of the leading indicators. But, around Australia, not everywhere properties go to auction. I think Melbourne's the auction capital, followed by Sydney and then Brisbane. Of late we've seen, I've got the stats later in the slideshow to show people where it's at. But I think that one can be a bit overused. But particularly around median prices, this is one that I've got a big bugbear about, Terry, is that there's such a reliance on median prices as a leading indicator of changes in value. Now, for me, I much prefer to look at repeat sales or the volume of sales going on in an area to look at where the value of property is going, because medians can fluctuate wildly. Take the eastern suburbs, like a place like Vaucluse or Bellevue Hill, where your median house price can be 5 million, but it could actually increase to 7 million if there's some $20 million sales, but there might only be a handful of sales. So you've got to look at really relevant comparable sales and also repeat sales of the same types of properties to get an idea on where value sits in a specific suburb. So what's your take on medians, Terry?
Yeah, I agree with you. People should be very, very cautious about how they read them. Media loves them, and they're constantly publishing lists of the places that have grown the most, the median prices in the last 12 months. even if you could believe that those median values and the movements are valid and accurate, basically all it's telling you is where you should have bought 12 months ago. It's not really informing you about where you should be buying now for the future. Mm. You mentioned sales volumes. That's the main marker that we use at hotspotting. We look at all sorts of different markets, including vacancies and rental movements and listings. But sales volumes, I think, is a much better marker of where people should be focusing their attention, because it's a precursor to price movements. If sales volumes are rising steadily quarter by quarter, we're likely to see price growth, and it also works in the opposite direction as well. If sales activity has fallen off a lot, it means demand is dropping, and so price growth is likely to stop or prices may fall. So that's what we do every quarter. We look at sales activity, which means demand, in every town and suburb in Australia, looking for locations that are showing patterns of growth or decline. And I think that's a far more important marker than what's happened with median prices in the last 12 months.
And I guess too, Terry, it's also challenging for markets or suburbs that are very tightly held. I guess your sales volume data has to look very accurately. It might only be a small change in the volume of sales, but where it's trending is the key indicator, right? Because, you know, CoreLogic just came out the other day talking about the level or the length of hold for most homeowners, which is tended to increase over time, which tends to show that we're having people are holding onto their properties for longer, which is also symptomatic of the price of transaction is changing. Stamp duty is expensive. So I think there's challenges in also interpreting that sales volume data because people are holding for longer, right? What do you say to that?
I think that's true. People are holding for long, but nevertheless, there are patterns to be seen. We're actually right now going through the latest batch of data, the quarterly data, and I've just been focusing in the last couple of days on regional Victoria, which happens to be one of the markets that's been showing the strongest growth trends in the last couple of years, which points us to another of the problems for those who rely on mainstream media for the information. There's an obsession with our major media with Sydney and Melbourne to the exclusion of other locations, and I think you're highly active, although you're based in Sydney, you're highly active with your business in other parts of Australia.
Yes.
There are many good growth markets with great potential for investors in other parts of Australia. They're not getting any attention at all from mainstream media, and regional Victoria is one of those places. And I've just completed some figures this morning which show that 84% of locations in regional Victoria have had price growth in the last 12 months. And that comes on the back of the patterns we're seeing with sales volumes, when locations like Geelong, Ballarat, Bendigo, and many other places in regional Victoria have had a steady rise in sales activity, which means demand has been rising. And that's translated into price growth, which is still playing out. The growth is happening right now in many locations in regional Victoria and other parts, regional New South Wales as well, increasingly in regional Queensland. So, lots of growth markets to be found. We're identifying them in the first case by looking at sales volumes figures, not at prices.
Okay, that's really good. I think another myth to kind of to wash away is that there's no capital growth in regional areas. There absolutely is. And you can get both growth, capital growth and yield in some of these regional areas. But I think the key to any investor that's looking to buy into a regional area is to look at the local economy and check that it has a number of sustainable markers or sustainable drivers. So we always talk about the three, PIE, the population, infrastructure, and employment drivers. And if the region has those three key drivers and there's good longevity in those markets, then we believe it's a safe market to invest in. So it doesn't mean you just pick any regional market and buy there, but again, it just comes down to looking at those core factors, Terry, as well. The other point I just make, Terry, just about this slide about Australian house prices is we often talk about, there's the media paints the picture as one property market, and there's just so many micro markets that you need to evaluate. So it's very important that our investors drill down into to look at what's happening at a very localized level.
Yeah.
So Terry, sorry, you're going to say?
I think it's very important to examine the economy. We believe that real estate markets arise out of what's happening in the local economy. Media keeps talking about the Australian property market and what's happening with Australian property prices, and you and I both know that there is no Australian property market. There are thousands of different markets, all dictated and driven by what's happening with local events, local economy, local spending on infrastructure, local demographic factors. Is the population rising? Are jobs being created? Is it a diverse economy? So I think that successful investors will be examining those things. They'll be looking at a location and understanding what's driving the economy, and looking for diversity and strength and growth and all of those factors, because that's where the real estate market comes from.
That's it. And so, Terry, just move on to the next couple of slides. So a lot of people, we're talking about data and they think that's great. Well, I'll just jump online and get some free data. What's the problem with just going after the free data?
Well, I suppose you could argue that it's free for a reason. Quite often, stuff that's free is free because it's worthless. And that's not, that's a very generalised comment. There is some good data out there that's freely available, but there comes a point where if you want real quality data, and in particular analysis of the data, then you're going to have to be prepared to pay for something. I think that there's no shortage of facts and figures out there. Firstly, you've got to know where to find them, but having found them, you've got to know how to make sense of them. And quite often that's where people struggle, and they need expert input, and they need to be willing to perhaps spend some money on good reports that have done all that work for them, identify the good places, but analysing the data and making sense of it. You need to be looking at information about prices, about yields, about rentals, about vacancy rates, about the economy, about population and demographic trends, all of that. It's quite complex. They'll all play a part in informing a person, a potential investor in a location. And there's no one place you can go to get it, because there's very specialists out there who provide certain types of data. It's all out there. In fact, there's almost too much information, and the hard part is making sense of it. And that's when I think people need to talk to someone like yourself, Rich, who's out there at the coalface and can make some sensible facts and figures on behalf of your customers.
Well, I think that's it, Terry. I think that kind of leads us to the mindset of investors that are, it's not just a direct plug for buying data, but it's a saying to people, look, if you're going to do something like buy an investment property, you're effectively buying a small business. And you wouldn't buy a business without doing enough due diligence on it. So as well as there's plenty of free data out there, it's important to pay for the right kind of data that's going to help you to make a good decision. I think most people probably spend more time on their annual holiday planning than they do buying their investment property, and they're trying to get the best room rate, the best tours, and the best food outlets. Well, apply the same logic to buying a property, but just go a couple of steps further. While there is some good free data out there, it's important you get the right kind of data. I mean, in my business, we spend hundreds of thousands of dollars a year on data. So we've got all the major data sets, and we really enjoy your data, Terry, which is very insightful. So we look at all of that from a macro perspective, and then we drill down to the local area to get a real feel for what's happening in a local area basis, because that's really, really important as well. So I think the message here is don't skimp on research. Spend the kind of money that you need to spend to make the right decisions in buying a high quality asset.
And what the slide on the screen, Rich, is seeking to portray to people is that most investors are willing to spend those big dollars on the property, but not spend the relatively small sums on making sure that they spend that $500,000 wisely.
That's right.
$50 on a research report, or a few $100s on an independent valuation to make sure you're buying at the right price. In my experience, most investors will skimp on those small sums, spend the big money, and that's the worst kind of false economy, as the slide suggests.
That's it. So, Terry, now that we've sort of talked about data, I just want to talk about how do we interpret data. And I love this slide because we often perhaps look at ourselves in the mirror and think of us as younger than we perhaps are, or with bigger muscles or more beauty than we perhaps have. And that beauty is in the eye of the beholder, as they say. So I just want to talk about what I call perception bias. I think we're all born with a certain level of bias in the way we feel about things. But when it comes to the property investment and looking at finances, how do we become aware that we have perception bias? And I guess how do you define perception bias, Terry?
I think it mainly relates to myths and misconceptions that people have. I often encounter people have very, very strong views about real estate, about the best places to buy, the best sorts of locations to be in. It's not based on any research data or any and a hard homework that the investor's done. It's just, I don't know, it's an attitude that people have gained somehow along the way, such as, you get the best growth in the prime areas or the inner city areas. And you and I both know that that's not really supported by any data. It's about the intrinsic qualities of a location rather than is it close to the CBD or is it one of the prime suburbs of the city. So I think people need to think in terms of perhaps ask themselves some hard questions. I've got this attitude about that. Where did I get it from? Is it based on any? Could I stand in front of an audience and argue for my perception with hard data? And if the answer is no, then maybe you need to think about unlearning what you think you know.
That's right. Yeah. I mean, we sometimes have a couple of frank discussions with our clients that have engaged us, and they will believe that a certain property is worth X. They say, "Oh, look, this property is definitely only worth 900,000," and we'll say, "Okay, that's interesting. You have that view. On what basis are you making that comment?" And we'll show them a number of properties that have recently transacted in like several weeks ago for 950, and they keep saying, "Oh, but it's not worth that. It's not worth that." And we go, "Well, there's been 4 public auctions." And there were 10 registered bidders at that auction, and they're all prepared to pay 950. Why do you say it's worth 900? They go, "Oh, it's just not worth that." So I think we have to look at the market, and we have to look at the data to work out what is actually the reality. The other thing around perception bias, Terry, is some people, as you say, think that capital growth only comes from one particular driver. It might be it's got to be on the rail line, or it's got to be within walking distance of a hospital or some other factor. Now, those are good factors, but there's not one particular driver that's going to lead to the capital growth of a property. It's a number of factors in combination. And there's been lots of studies done called hedonic pricing studies that look at those individual factors and will work out a particular weighting. But that's a very, very sophisticated level of analysis. So I think all I'm saying is that whatever perceptions we have of what drives the market, it's important to bear that out in reality and look at what comparable sales have sold for. Because for me, that's one of the key drivers determining the value of property. Because the definition of a value of property is the utility or the satisfaction you get from it. And value is determined by a willing buyer and a willing seller in an open market situation, not a forced situation. And that definition I've just quoted has come from a court case in WA from many, many years ago, that value is used as a determination of value. So I think it's important that that viewers are aware of how to determine value and the factors that make up the value of a property, and don't go in with just a preconceived idea. Any other thoughts on how to kind of overcome perception bias, Terry, in terms of property data?
Look, just for reference to what some of the comments you've just made, it can work in all sorts of ways. A buyer saying that property isn't worth that much, it's only worth 900,000, when the market evidence suggests that similar properties have sold for considerably more. It can work in the other direction as well, a vendor having a fixed idea about what their property is worth, or rather pricing the property in terms of what they want to get. That's right. Which can often be quite irrelevant to, if they price it that way, it's going to sit on the market unsold for a long time, become stigmatized, and ultimately it's going to end up selling, if at all, for a much lower price. So it's really important to base those sorts of decisions, whether you're a buyer or a seller, on expert advice. Be willing to get an independent valuation, or to consult an independent professional, not the selling agent, but perhaps a valuer or buyer's agent, someone who has experience in the market, can point to comparable sales and give an unbiased, unemotional appraisal of what something's worth.
I think also just to it, and it's a tactic that I use with selling agents, is if they list a property and say, "Rich, this one, where price guide is 1.2, they may have overquoted that property." So, well, that seemed weird to me because there's one down the road that sold for for 1.1. I don't really see why this is worth more. Oh, well, it really is. And then when you dig a bit deeper, you find out that the vendor has really asked them to sell it for that. And it's just the vendor's hope and dream of getting an amazing price, and that's why they've told the agent. So, but a good agent should have educated their client as to what to list the property for. But more often than not, we find that in the capital cities, in Melbourne and Sydney, is that properties tend to be underquoted, which tends to create more competition and gives the poor buyers a false and misleading expectation of what they should be paying, and that just generates more competition. So all the poor buyers end up spending money on their pest and building. They turn up at auction, the price guide's 1.1 and it goes for 1.3, and they just think, oh, that was a waste of time. So that's a common occurrence that's happening again in the current market as well.
Yeah, and of course, various state governments have tried very hard to weed those problems out of our major real estate markets by passing laws, but the problems persist.
Yeah.
And it just brings us back to one of the central points, that you can avoid a lot of those problems by having someone on your team who actually knows the market at the coalface, like a good buyer's agent, as a good example. It's money well spent. I think it's false economy to try and save that kind of the buyer's agent fee, because you may end up with a bad result. Whereas if you're willing to spend that money and get good advice, you'll end up with a result which actually will probably save you more money than the fee, or make you more money than the fee by making a good decision.
Yeah, exactly. So Terry, I'd like to move on now to the next segment and talk about goal setting and some various property strategies. So what I'd like to do now in this section is just talk about how do you set your plans moving ahead, and what kind of strategies could you use. So this is a slide which really is a fairly common sort of theme that a lot of people like to achieve. Is they'd love to achieve a net income per year, or net cash flow per year from their property portfolio of $100,000. So how do you get to $100,000 of passive income? Well, a simple way to do it is to buy 5 properties. So 4 properties worth 500K. Sorry, it should be a goal of 4 properties. I've done a typo in the slide. 4 properties at 500, or 4 at 5 at 400, either way, whatever the maths is, to get that. So you don't buy them all at once, you buy them over a series of years. And the next slide just shows you again how that works out in practice. So to get $100,000 in income, you start off buying 1 property at a time, and over say a period of say 15 years, you might end up with 8 properties. So that will give you a total gross value of property over time of $4 million. So at the end of that 15-year period, the original properties that you've bought would have increased in value. So you can pay down the original $2 million in loans that you have and end up with a $2 million net portfolio. And if you take, say, a 5% average yield, that will give you the $100,000. Now, I've assumed a lot of assumptions there, a lot of factors like maintenance and that sort of thing, but I'm just talking in round numbers. Now, obviously, if you want a higher income, say $150,000, you're going to need a net invested portfolio of around $3 million. So again, the simplest way to do that is to buy $6 million worth of property over time and then pay those original loans down once they've grown in value. So what are your thoughts on that strategy, Terry?
Yeah, I mean, that makes perfect sense, and those are good sort of ballpark numbers for people to aim at. And I think the key thing for people is to get started as soon as possible, as young as possible. The younger you start, the more likely you are to be able to achieve those kind of goals, and the more likely you are to achieve them relatively early in life, so you can have options such as early retirement if that's what you want to do. But make a start. Have a plan. It's very important to have a plan and to know what your end target is and how you're going to get there. I think the vast majority of people don't do that. You must see it all the time, Rich, that people decide that property investment is what they want to get into for various reasons, and they just start looking for things to buy without first doing a little bit of work to work out that kind of plan and then a strategy for getting there, because the plan is one thing, but how are you going to achieve that plan?
Exactly. And I think, Terry, the other thing is that you can't just buy one property and hope to retire with that one property. You have to buy multiple properties, and that's good for a couple of reasons. One, you've got to look at diversification, so buying in different suburbs, because each suburb will grow at a slightly different rate. It's also important to diversify potentially across different states and different property markets, because one market might be up one year, another market might be down. And when you want to sell those properties eventually, you want to make sure you're selling in an up market, not necessarily a down market. And I think a lot of people get stuck on one or two properties and get afraid of taking on more debt. So it's important that you understand how to manage debt and to manage your cash flow so that you can buy multiple properties. But it's the fastest way to achieve sustainable retirement. I know my own life that buying properties has been one of the best things for financial stability for me and my family. And I'm very grateful to have learnt it and taught others about this process from a very young age. So again, I want to train my boys and my family in how to do it. I love training others in how to do it. But as you said, Terry, get in as soon as possible and don't wait for the perfect conditions. I think everyone's waiting for that ideal time to buy. And I think it's a matter of also having time in the market. Like right now, and we'll get into the market update shortly, now is actually a very good time to be considering buying because interest rates are so low. It's still difficult to get a loan, but not impossible. But it's very much a good time to buy. I think, Terry, a question I often get is, look, I want to buy a property, but my partner or my wife is not on board. How do we get our partners or our better halves to get on board with the investment journey?
Oh, mate, that question's way beyond my pay grade. It comes down to the individual situation and the individual relationship, doesn't it? I think before you set out, if you're in a partnership, you both need to be on board with the overall goals and objectives. And if that's not the case, then you're going to find it pretty damn hard because it's a journey you need to take together. And
I think the key there is together. I think if you can't decide or agree together, get an independent third party, whether it's a buyer's agent or a financial planner or a broker. Have someone who's an expert in their field, but to give you some independent advice that doesn't have any vested interest in your decision making. So it's I know a lot of people that use financial planners that are particularly they're fine with properties and they're not just trying to flog manage funds, but use a good planner that make sure you're covered for your insurances, make sure you're covered with all the other aspects of your portfolio, so it's not just property centric. And I think a planner can really help you to get on board. So again, I know some great planners. If anyone's looking for a referral to a good planner, we can refer some. And Terry, is there any other thoughts just before we move off this on positive cash flow? How do you end up getting the cash flow from this portfolio over time? Is there any thoughts on how to make sure you've got the right kind of yield coming from this portfolio?
Yeah, I think it speaks to one of the great myths and misconceptions that are out there, that you've either got to make a choice between growth or yield. And I don't think that's true at all. I think if you choose your locations well, you can get a nice combination of both. And we've spoken a bit today about our regional Australia. Certainly, there is lots of good buying in growth markets with good long-term potential for growth in regional Australia. We're not talking about small towns. We're talking about substantial cities. And certainly throughout the eastern states, there's plenty of them where you can buy affordably and have good rental yields with the prospect of being at least cash flow neutral from the beginning. But these are locations that have good prospects for growth, and we've actually seen many locations in regional New South Wales, regional Victoria, regional Queensland, regional Tasmania, perhaps more so than anywhere else, showing really good capital growth over the last couple of years. So you can achieve all of that by choosing the location well. And if you're doing that and you're building a portfolio on that basis, as time goes by and loans get paid down and rents rise, the cash flow positive possibility becomes more and more realistic. So perhaps 15 years down the track, you should be in a position where you have good positive cash flow from that portfolio.
I think one of the lines you just talked about there to me says the word patience. A lot of investors that I meet are very impatient to get to that 4 or 6 or 8 properties in their portfolio and think, oh, Rich, it's just not working. You have to give your portfolio time. And as we've seen, the markets change, they go up, they go down. But as long as you bought in the right location that has the right drivers, you will see rents rise. You will see the values rise over time. They might come back a bit one year, but it'll be assured that if there's the right drivers, they will exceed the highs that they've had before. So it's very important to hang on for the ride and be patient with developing your portfolio.
And that point also speaks to the importance that of the point you made earlier about diversification. If you have a portfolio, it's important that they not all be in the one location. It's surprising how many people do buy multiple properties in the same location. Ideally, you would have 6 properties in 6 different states and territories, or certainly 6 distinctly different locations. So different types of property in different locations. So at any point in time, if one market is down, there's a good prospect that some of the markets in which you own property are going to be rising markets, because we don't have a single market in Australia, and at any point in time there are rising markets, there are falling markets, there are stagnating markets. So that diversification factor is really important from that viewpoint.
That's great. Well, Terry, let's move on to the fourth segment about motivation and taking action. And how do we get ourselves motivated to overcome sort of a reluctance? We might be feeling depressed that we just haven't taken action, or we might feel we're in our 40s and haven't really done anything, or we might have some past losses that have really hurt us. But what are some ways which we can take action? I'll probably just kick off this one, Terry. Again, as I said, I used to be an economist, and I would analyse things, and I had a disease called paralysis of analysis, and I would just analyse things way too much. And for me, I had to get external help, and it's not a sign of weakness, it's a sign of strength to reach out and get help with whatever it is you're facing in life. So for me, getting someone who was independent and a financial planner to help me get through some of the fears I had was really good. So I understood the difference between good debt and bad debt, how to manage cash flow, and to set realistic goals. But buying those first couple of properties really set me on a pathway. And I think for me, once you see a couple of wins and you get a taste for property investing, it can be really, really good. So again, Terry, what are your thoughts on ways in which people should get motivated and take action?
Look, I think the first thing is to have a goal. People start saving when they have a particular goal. They want to take an overseas trip, and that motivates them to start putting aside money. And I think goal setting is the first point. And once you have the goal and you start thinking about how you're going to get there, that's when you're most likely to take action. But I think the point we've made again and again today, and it's worth repeating one more time, is get some professional help. That's often the thing that gets people motivated and started and step forward. Because I think what stops people more than anything else is, and the word I hear most often from potential property investors, is overwhelm. People get overwhelmed by the enormity of what they're taking on. They get overwhelmed by what they see as their own lack of knowledge, and they get overwhelmed by the number of choices that are out there in a country as big as Australia. How do you get beyond the overwhelm? Well, you get professional advice. You start building a team around you, people who have experience, who have done it, and can help you get started by helping you get beyond each of those points of overwhelm.
And I think it's really important to get your first property right, particularly your first one. I mean, I've helped people that have got 40 and 50 properties in their portfolio, and they're still using our services because they understand the value of leverage and they understand the value of local knowledge. But it's really important, if you're buying your first or your second property, to make sure it sets you up, because if you buy a dud property, it's going to set you back 5 or 10 years. So it's really important to make sure you're buying the right kind of property. The other challenge a lot of people are having at the moment is getting finance. So I'll just quickly cover this one off, Terry. If you're having trouble getting finance, it's important to speak to a very savvy broker, not just an ordinary broker, but a really good broker that understands both the bank criteria and the second tier or non-bank lending criteria. Now, the loan market is changing rapidly. We've had a Banking Royal Commission and lots of changes through APRA around serviceability requirements. So if you are getting a knockback consistently from a bank, it might be, sure, your income might be too low and it's just impossible, but there could be another lender out there that could possibly help you. So make sure, as your first step, speak to a good broker. If you need a recommendation, just ask us. We're happy to refer someone to you. But make sure you speak to a good broker and you understand where your financial position is at. And then you'll be in a much stronger position to know what you can afford, and then where you can buy to move forward with your plan. And Terry, just in terms of motivation, I was a co-author of this book called The Secrets of Property Millionaires Exposed. And this has got some great stories. I've written a chapter in this book about my background and my experience, but there's some other great stories in there. So I'd really encourage you, if you're on your investment journey or just want some other insights, and it's really cool. I've got a discounted opportunity to buy this book for just $20, including postage. So if anyone would like a copy of that, just shoot me an email to info@propertybuyer.com.au and we can get that out to you. But it's certainly worthwhile reading, and got some other great stories in there to have a look at.
Yeah, and I think it speaks to a good point on the subject of how do people get motivated and get started. Reading good books about property investment written by people who have been there, done that, and have had success with it is a great way to get over some of those humps in the beginning about the fear factor, and the lack of knowledge. And so I think reading a book like that is a really good ethic to have as a property investor. You should be reading as much as you can, but not newspapers. Read some good books on property investment by people who have been there and done that.
That's it. So turn off the news and start reading books, Terry. That's the message, right? So.
Well, I keep telling myself every single day, because I've got a very large pile of unread books on all subjects. But, reading is a great habit to have. It's a great culture to have as a lifetime thing.
Yeah, great.
Be a book reader on all manner of subjects. Excellent. Read about successful people.
Yeah. Yeah. All right, so Terry, let's move into the last segment on market update, and we've talked a lot about where the market's up to, given a couple of hints. But what's your just before we get into the detail, what's your spin on how to interpret the market?
Look, I think the first point that people must understand is we don't have one market, and you can be forgiven for believing that we do, because media keeps talking about the Australian property market and what's happening with Australian property prices. And it's so misleading, and it's so unhelpful to real estate consumers. So understand that we don't have one market. We have many, thousands of markets, and they are all moving in different directions and at different speeds at any one point in time. It's very rare for Australia to have a true nationwide property boom. In my time, there's only been two. One was in the late 80s, and one was in the early part of this century, when most of the major markets around the country were moving upwards in unison pretty much. That's rare. So that's the first point to understand. And media tends to focus very much on Sydney and Melbourne, and then take what's happening in those two big cities and turn it into a national situation, and it's not the case. So we've had a boom in those places, then a correction or a downturn, and now we're seeing recovery in those markets. Meanwhile, out there in the rest of Australia, where about 16 million other Australians live, not in Sydney and Melbourne, there's all sorts of other things happening.
Well, let's have a look at that. I mean, you've got one slide here, which we'll just quickly look at, where house prices numbers are, depending on which data source you're looking at, are quite misleading. But just quickly your comments on this slide.
Well, it tells you a couple of useful things. Firstly, when media publishes data about what's happening to prices and state it as a fact, it's not a fact. As you can see from the figures on the screen, no two sources agree very much about what's happening in any single market. I mean, we've got one source saying that Darwin's down 11%, and another source saying it's actually up 1% in the last 12 months, etc. Perth down 8%, or it's line ball with where it was 12 months ago. Who do you believe? Well, you've got to take all these figures with a grain of salt. The other thing it shows us is that Sydney and Melbourne have been down. Brisbane and Adelaide have been just chugging along with sort of minor growth, generally speaking. Hobart's been continuing to do well as the best of the capital cities in the last couple of years. Canberra's also chugging along quite healthily without exhibiting boom time growth. And
let's look at this slide here. This is where you actually got the actual numbers. This is the last 12 months. Is that right, Terry?
Yeah. Well, this is one of the problems with the data that's published by many of the research firms and published on a daily basis by mainstream media. They have these generalised figures. One figure to describe the whole of Sydney. I mean, how ludicrous is that? You're based in Sydney, Rich, and you know how big the city is, and there's over 700 suburbs and markets as diverse as Manly versus Penrith and
Mm.
Bondi Beach versus Campbelltown. I mean,
That's right.
how do you distill all that into one figure saying this is what's happening with Sydney prices? So we look at it on a suburb by suburb basis, and what we found is, notwithstanding those figures that say Darwin's up just 1 or 2%, we found that 70% of Darwin suburbs have had price growth in the last 12 months, and very similar in Canberra and Brisbane. Hobart, it's like 90% of suburbs are up, whereas in Sydney, it's a very small percentage of suburbs have shown growth in the last 12 months. And then you have regional Australia, and we've got there that slide that says 80% of regional Victoria. We've just done this morning, the latest figures, is actually now 84% of towns and suburbs in regional Victoria have got median prices higher than 12 months ago, including many that are up in double digits. Regional New South Wales has growth markets, regional Queensland has growth markets, and regional Tasmania has done very well. So there's lots of growth markets out there. We're not really hearing about them because we've got this obsession with Sydney and Melbourne, the downturn, etc., and now the correction, the recovery. What about the rest of Australia? That's where most of the growth is happening right now, and we're not really hearing about it.
That's right. Well, look, I think it's really important to look at that. And Terry, you've got some other slides here which just talks about exactly some of those specific suburbs. So obviously Ballarat has been up quite significantly, 13%. You see in Sunshine Coast, particularly Sunshine Beast, up 37%. And also regional Victoria, Echuca 11%, Kyneton 10%, Mildura 10%. So there is some places around Australia right now that are out of the cities that you're getting double-digit growth in.
Yeah, and it's really important to understand why that's happening. At a time when Sydney and Melbourne have been falling, we've got these markets like the top end of the Sunshine Coast showing this extraordinary growth. And why is that happening? Well, there's big things happening in the Sunshine Coast economy, massive spending on infrastructure happening there, new industries being created, more to come. And so that market has been an outperformer. Ballarat doing so well? Well, a lot of buyers out of Melbourne post boom when prices rose a lot, both home buyers and investors looking for a higher level of affordability, better rental yields, perhaps a different lifestyle for the home buyers. So, Ballarat's pretty close to Melbourne. It's a strong city in its own right, diversified, but commutable. So for all sorts of reasons, Ballarat's getting demand. And, we could sit here for a couple of hours and talk about other examples, but those are just a couple that are pertinent to the discussion about, yes, there's growth out there, and it's all coming out of what's happening with local economies and local dynamics.
Yeah, okay. Well, that's fantastic. So, Terry, I'll just give a quick, again, some of these figures that I'm going to share now are again, based on some of the city areas, but this is the clearance rates from last Saturday, particularly in the regions of Sydney. We had a clearance rate of almost 84%. So incredibly high, very, very strong auction results. The numbers were a bit low, obviously only 277 there, but it just goes to show that the lack of stock and the high demand is seeing prices rise. So the asking prices in Sydney have been rising quite strongly. So vendors and sellers feel like they're back in the box seat. The other thing, just that we've mentioned before, again, this is going back to the actual change in dwelling values, which combines both house and unit prices all into the one figure. So this is a very generic figure, but it shows the trend. And you can see the bottom of the chart for Sydney, Melbourne, particularly, and Brisbane, is all, the curve has turned, the worm has turned, so to speak. So we're very much in recovery phase now, and it will be interesting to see how fast that recovery is. And I'll talk about that in a minute as to how fast I think it'll be in the different markets. But I think Brisbane particularly is tipped for around a 20% growth in the next 3 years, according to some of the other experts. I think Sydney particularly will have a fairly strong rebound. And also look at Hobart and Darwin and Canberra. And as you've said, Darwin has seen a bit of an uptick stretch there. Canberra has been doing quite well. Its price growth has been quite strong the last couple of years. Its price growth, I think, is moderating somewhat now, but there's still very strong demand there. Now, the reason, particularly for the Sydney and Melbourne clearance rates being so strong, is there's just a severe shortage of listings. So if you look at the actual numbers in Sydney, in terms of new listings, we're down 31% in Sydney. In terms of new listings, down 26%. overall year-on-year change is around 15% decline. So that lack of stock, which typically when spring hits, you tend to get a flood of properties hitting the market. We just haven't had that in the early spring season yet. And a lot of the agents I'm speaking to saying, well, we're not actually seeing a huge volume coming on. There's a trickle, and we're hoping it's going to be a good run. But there's often a lag effect between when the market has seen an improvement and when vendors are actually prepared to sell. And I think one of the reasons for a lack of listings is some vendors are a bit scared that if they sell, they're not sure where they're going to move to. So that's been another driver of activity or lack of activity in the market as we go forward. So Terry, just to wrap up, I'd just like to sort of mention how should investors and home buyers perhaps approach this market? It's we're moving into a recovery phase, and we've seen what's happening in the market. How should investors move into this market? So one of the things that we've mentioned about is seeking expert help, and this is the process that we take our investors and home buyers through. We sit down with them and chat about their strategy. We give them the research on the areas we recommend. And then we do the hard yards of finding these specific properties that meet the investment grade criteria. Then we sit down and do a detailed evaluation of those properties and tell our clients what they're really worth in today's market, not tomorrow's dollars or yesterday's dollars. What are they worth today? Then we conduct further due diligence on them. And then we negotiate to get the lowest price we can. And that really removes that emotion that we've talked about at the very beginning of the webinar from a lot of those processes. And then we arrange for settlement and also a property manager. So we provide, as a buyer's agent, provide an end-to-end service for our clients and take them right through that process of searching through to buying. What does that cost? We work on a fixed fee basis. So for any property under 500K, it's simply 9,000 plus GST. You're looking for properties over that, we have a fee schedule, which roughly is around 2%. And once you get over $1 million, it's a sliding scale, which is less than 2% down to about 1.5%. But it gives the buyers obviously a personalised strategy. It gives them access to off-market properties, and it really speeds up the search, particularly in rising markets. It can be quite hard to get into those competitive markets, but we have an edge because we're seen as a repeat buyer for those agents in that local area. I think Terry, we provide a service right around Australia. I've been the president of the Buyers Agent Association of Australia for the last 4 years, and I have a network in my team and outside of that to find properties right across the nation. And we've been given a few awards for our time as well. We're actually up to 33. Actually, this coming week, I'm up for the Buyers Agent of the Year award again with the REB and also the Real Estate Institute. So hopefully, fingers crossed for that one. And Terry, I think I'll just maybe just ask for any closing comments that you perhaps have in how investors should really take their final steps to knowing their emotions and getting set for the future.
Yeah, look, I think it's really important for people to put in some time with the planning stage. You've just gone through a multi-step process. You take your customers through. We have a multi-step plan that we talk about as well. And step 7 is actually looking for things to buy. And there's 6 steps that come before that. That's all to do with understanding something about yourself, making a plan, developing a strategy to achieve the end goals and objectives, getting on board with some good quality advice, and very important to do some real research. So all of those things really need to happen, and you can make it a whole lot less daunting by being willing to bring on board expert advice and good information and be willing to pay some money for it. Because you're going to get a much better outcome. You're going to make more money in the long run if you're willing to do that.
That's it. Yep. Well, I think there's some great advice there, Terry, and I hope our viewers tonight have really got some great benefits. And I just really encourage you, if you have any further questions or you'd like to talk about our services and avail yourself to those, then we'd love to help you on your property journey and help you make wise decisions. So I just encourage you to be aware of your emotions, lead with the head, not necessarily with the heart. And don't justify your decisions by emotion, but really get the right advice and the right team around you. So I think, Terry, we might wrap it up there, but just want to say thank you so much for watching tonight, and we look forward to helping you on your investment journey and staying in touch in the future. So thanks again, and all the best. Here we go.